Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, June 12th, 2019. I'm going to start this one a little bit early because no matter what happens, we're not going to really, it's not going to change how we're going to finish the day as far as technical development. So we don't have any major technical developments. We had a slight down day on the SPY, nothing to get excited about, down 0.25. QQQ down a little bit more, zero point 0.6. So no major technical developments, but certainly some technical developments worth mentioning, and that's why I'm doing this video here. All right, so first and foremost, we're going to start out with the daily time frame. Yesterday, I had highlighted the fact that we had put in these bearish engulfing candlesticks on all the major indexes except QQQ. Small caps had it, the Dow had it, everything but the Qs, and those also followed a shooting star. So we had this candle right here, shooting star candle, followed by a bearish engulfing. That is potential topping patterns. We say this, bearish. You read up on candlesticks. There are single day candles that are bearish or bullish, but to put the odds in your favor, there's a lot of randomness in candlesticks. You want to see multi-day reversal patterns, and as I said, that's sell signal number one came yesterday, and then I said I really like to see confirmation on bearish engulfing candles with additional downside the next day. And the last time we had a bearish engulfing candle on SPY was right here. You can see that we engulfed the previous, multiple candles there, and that marked the beginning of the biggest correction so far year to date. So that was the biggest drop the market's had since December, and it was again preceded by or marked by a top with a bearish engulfing candle. So you need to respect these. Now, if we continue down, that helps to affirm it. I also I went over on a video from members earlier today with a couple trade ideas. There were some stocks that had put in some nice big solid bearish engulfing candles, and again all the other indexes did. As a trading style, what I like to do, and I'm not doing it here, and I'll tell you why in a second. I'm holding off right now, and one reason is I have short exposure, but I'm also waiting to add. I need additional confirmation now. I'm not going to add any more on the way up. I'm going to wait till we go down and start to firm up this case for a reversal here. So with that being said, now normally where let's say I didn't have any short exposure coming into yesterday, I would when I see a bearish engulfing, what I'll do is I'll either short it that day before the close, or next day if you open down, start trading down. And I like to set a stop a little bit above the top of the candle. And when you do that, your risk reward is extremely favorable, because remember, these are reversal sticks. They're used for trend reversals, not just little quick pullback trades lasting a day or two. Sometimes that's all you get. There's no guarantees, but so therefore your risk reward is usually very favorable. In SPY, it would have been anywhere, less than 1% stop for what could be, easily double digits on the downside if that pans out. And a tight stop, if you don't like that, if you want to keep it very tight, you give it at least about 2/3 or 3/4 of the way up the candle. Sometimes you get a kickback rally, and if the bullish engulfings are going to hold, that's usually where any kickback rally shortly afterwards will stop. There's an example. You had one right there. It came up about 2/3 or 3/4 of the way of the bearish engulfing, and then boom, we continued lower. So that's that. And again, we put them in. There's the closing bell. We put them in SPY as well, or DIA, the Dow. And there's IWM. And again, it doesn't matter if the candle is green or red. You just want to see it down towards that end. As I like to say, the redder the better, but you'll take that. So across the board. Now, let's not forget, and I just, I kind of have to continue to do this because as I do these updates and these videos, I have different time frames, and I might sound contradictory. Well, sometimes I'm long, but yet I'm talking about being in a bear market, but I'm aggressively trading alongside, or the other way around. And right now I'm looking, after being bullish and long for about the last week or so until the end of last week, I've now switched over looking for the next leg down. And I want to say what formulates my bias largely are these long-term charts. This is a weekly chart of IWM telling me that IWM is most likely in a bear market that started back in 2018, as many sectors and indexes are. And then we go back to the monthly charts, those are extremely bearish to me. Why? Well, last month, remember, we had bearish engulfing candles on the monthly. You do not get those often. When you get them, you need to respect them. So we had that last month on all the major indexes. Again, there's SPY. Here's IWM, or I'm sorry, DIA, the Dow, bearish engulfing candle, just like we had a bearish engulfing candle back there. This was the biggest drop. Technically speaking, it was a bear market. Most indexes dropped over 20%, at least the Nasdaq did, and some others. But that led to the biggest drop again that we've had since the last bear market in 2008, and that came after a bearish engulfing on the monthly, and we failed to even match that high on the Dow after one of the strongest uptrends, in a while, and put in another bearish engulfing. Now here's the thing. This month is not over. This month is still young, very young. So there's a potential to undo that, just like I talked about on those daily charts. So these are things I'll be watching. If we close the month up above there with a big green candle, well, we've negated that, and especially if we, take out those previous highs. So those are things to watch for. But as of now, they tell me, hey, there's a lot of technical damage done on the charts lately, not just the daily, the monthly as well. You can go back to QQQ. And this is, this chart goes back decades, and you can see back in the after the dot-com bubble, the top in 2000, we had a sharp leg down. That may have that candle, I believe, engulfed. Yeah, it did the previous body. All you have to do, the body, the fat part has to engulf the body of the previous, and then we had a bearish engulfing right there on that strong bear market rally. And I did this in recent videos to try to put it in perspective. This is QQQ, which rallied 44% back then after the highs was on the first bear market kickback rally, which makes this rally pale in comparison, with this one only up about 33%. So just the big moves come, and that's what we're seeing in recent months. You go back to the daily charts or the weekly charts, we're seeing unusually large up and down trends, and those are indicative of, again, a market top. But we'll see. We'll take it one day at a time. Okay, I showed you all the bearish engulfings on the dailies. And then also Microsoft, I wanted to mention. Microsoft being the largest company in the world, the only one that still has a $1 trillion market cap as of right now. I mean, the others are close, but this is one of our big, what I call the FANG stocks, FAAMG, with Amazon, Alphabet, Facebook, Microsoft, all those big companies, and they are the top components of the S&P 500 as well as the Nasdaq 100. And so this is a pretty ominous sign. You had a bearish engulfing candlestick yesterday, engulfing that previous stick, and then a follow-through red candle today. And that wasn't everything. That's, again, I don't use these candles as a be-all, end-all, but the last time we had one was right there back before this correction right here. And one other thing, we put back the lines on the chart. So we had that bearish engulfing also came with a potential divergent high. I say potential because we need to reverse. I might have normally, and I said this on the site today, normally I might have shorted Microsoft on that bearish engulfing candle, and or on today's follow-up confirmation move down. I didn't do that for several reasons. Number one, I already have, all the short exposure I want at this point in time. I have room to add, and this one may get on that list if the following pans out. But we had that. We also have a very important support level. I don't take short trades after, let's say, a trend line or a chart pattern breakdown or a bearish engulfing, bearish reversal, if it's coming right above a key support level. Why is 130.46 important, or give or take, call it 130.50 if you want? Well, Microsoft back here popped out to a new all-time high at this point. Gapped up, I believe it was an earnings-induced gap, and then for the next 5 days, 5 consecutive candles, tested and failed at that level. Tried to pop it, and could not hold a close above that level. Closed on or below it after tagging it every time. That in itself makes that a pretty significant resistance zone. What happened from there? Couldn't hold it. So it fell back and rallied back up, and you can see right there another perfect tag of that level. Pulled back again, finally had the power to go on and break out. So on face value, and right now, unless this is undone, that's bullish. That's a breakout to new all-time highs, and it did so by breaking above a pretty well-defined resistance level. Resistance, once broken, becomes support. So therefore, right now, what I'm watching on Microsoft, I'll give you the bullish and the bearish. If you are bullish, you can certainly buy this. This is a back test to a breakout. So TA 101 says you buy a breakout or you buy a back test of that breakout level, pull back to support, and we go on up. If we do so, can we take out these divergences? I can tell you that I wouldn't be chasing it, at least not for a while, because we have negative divergences building here. They're not yet confirmed. By confirmed, if the bearish scenario plays out and we drop below this level, it doesn't have to be tomorrow, but ideally it should be before Microsoft takes out that previous yesterday's bearish engulfing candle. That needs to ideally remain under there. So you get a red candle down, the indicators will roll over, and once you get a bearish crossover on the PPO down here, effectively you then have what I call, this is not in the textbooks, but it's what I call confirmed negative divergence. Most people would say, and technically this is negative divergence, because your indicators, in this case a PPO and the RSI, are making lower highs with prices making higher highs. But I like to wait till that PPO crosses over for two reasons. Number one, in itself, it's a sell signal. Bearish PPO crossovers, you just follow price up. When you get the clean separation of the lines, they usually do a good job of indicating a trend reversal. And more so, this is a momentum indicator, and as long as it's moving up, as it is, it's pointing higher, it can keep going up. So we can burn through there. The momentum is to the upside. So what I want to see is the momentum turn down. The stock turns down, this indicator will roll down, and then you get the bearish crossover. And at that point, if you get it before it takes out this previous high, you've effectively put in a lower high. And so that's what I'm looking for there. So there's all potential stuff, but again, there's a lot of stuff in the charts that tell me that to be on the lookout for that. And if so, on my weekly chart, which I shared on the site today in the earlier video, the downside targets are pretty impressive for this. They're let's just say I have two targets, an intermediate trend target, and I think that was 20-something% down. The next one's just over 50%. And that would just be a start. But again, it's a lot. This is all daily chart stuff. You can't see that, or I can't make that case just on this alone. I have to go out to the weekly and monthly charts, which I've done, and that's what indicates that where you might think I'm crazy calling for a 50% drop over the next year in Microsoft. That's what I see in the charts right now, and maybe they'll prove me wrong, and only time will tell. Okay, now zooming down to the 60-minute charts, I'm going to give you both sides of it. Be very clear, as I always am, where I think things are going. I think this most likely was a counter trend rally with more downside to come. But there's a couple things here. My convictions right now, we need to first of all firm up that this isn't anything more than just a little consolidation. In fact, I'm going to start out with the bullish scenario here, potential bullish case. I'll start out with the most bullish case. Now I'll say this is not my favorite case, but remember on Friday I pointed out these bull flag patterns. And you can take it. I said you can take the impulsive move here, and then you have that smaller move, which did play out, or you can look at it this way and say this was a flagpole and you're going a lot higher. Well, this fits better. And it also looks, closer to what, if you look up, and you can just do a Google search and you'll find bull flag continuation pattern. You'll see it consists of three parts. The impulsive move up, called the flagpole, level of a pullback, a slight correction as prices consolidate on lower volume, and then a breakout on impulsive breakout with a move that's roughly equal in intensity to the flagpole, and that's what we had there. Now, if you step back, and it'll probably show better on a 4-hour chart. And again, I'm just giving you what could be a bullish scenario if you want to trade it, if you do think the market's going to new highs. This now would be a much larger, and it would mesh with this being the flagpole. So if that's your flagpole, the way you measure that out is you take the, let me add a drawing board here. Okay, the easy way, you can pull out your calculator, but I just take a trend line. So I draw the flagpole with a trend line. I'm going to have to move this down a little, give room, and then add that to the lowest point of the flag before it breaks out. So that would be, obviously that's the most bullish scenario right there. So that's your what is a potential bull flag pattern. It would take the markets to new highs. It wouldn't, I can tell you, we'll have to just see what the longer term charts look like. But there's a scenario you might want to watch. And what would you want to see? Obviously, again, you want to see an impulsive breakout, a lot of big green candles, not a lot of red, not a lot of give back, something roughly comparable to that move up there being the flagpole. So that is the most bullish. I don't think it's going to happen. I think there's too much technical damage inflicted on the charts, the weekly and monthly charts recently. But again, I've traded long enough to say anything could happen, and I want to point that out for you guys in case it starts to, or especially if you're bullish and you're trying to gauge, where to swing trade, where's your price targets. That's the technical measurement. All right, so back to the 60-minute charts. Now let me give you what I believe to be the most bullish scenario, not my preferred. I'm giving you 3 scenarios. The most bullish that I don't think will happen, but certainly could. Now, this is what I call my alternative scenario, which is both. That's not it. It would have us doing something like this. You remember I've been harping on my this 186 level. That's where I start to become concerned about the case that this has just been a counter trend rally and a bigger move down, and that's where I said I'll start scaling out of the shorts that I just started scaling into late last week. All right, so that would be, it would look something like this if we head up to that target, or that resistance level, because we haven't hit it yet. We'd come up here, hit that level, reverse, and then hit the downtrend. What that would do, if that were to happen, let's say tomorrow and or maybe into early next week, it would give us what we don't have right now. It would give us negative divergence here on the 60-minute charts, because our indicators would pop up like this, and again, contingent on a reversal on or around that level, give us that negative divergence, just like we had right here before. Again, the biggest drop in 2019, divergent high right there, negative divergence, and just like we had bullish divergence here. That's a big part of my trading. It's not completely necessary for a trend reversal, but when you get them, it's all the better. And so that's again what would be like saying again the bullish of my 2 scenarios, and with my preferred scenario saying that we're done. We overshot my bounce targets, which were about, my uppermost preferred bounce target was 183 on QQQ. We overshot that by about 1.2% right here, and I view that as at this point in time as just what I call momentum fueled overshoot. And again, I gave a range where I thought things would go. It's hard to, sometimes nail the tops, nail the bottoms. And so that is my preferred scenario. And what that's going to entail is we danced all day today on that 182.24-ish level that I have. It's a big old gap right there. That's what's happened today. The market was testing a gap from above. Very strong, healthy action. When you come in and backtest a gap from above, it's usually one and done, but it doesn't have to be. Either way, this is a support level, really the top of the big gap from the other day, and then the bottom of the gap, so around 180.84. So if the gap gets entered, most gaps once entered are usually backfilled. That would be our next support level. So what would start to firm up the bearish case so far? Well, we have the breakdown of the trend line. If we break that support level, backfill the gap, that would certainly be a check mark for the bearish case. But then, bulls could still step in there and take it up. So what I'm watching is each of these levels, if they are hit, how do we act? Do the buyers step in, or do we just go on through those levels? And usually how tops and bottoms work is, unless you have an really stretched move, you come down, you test those levels, and as the rally gets, or the correction gets going, the selling gets more impulsive, just like it did here. See right here, you had a little bit of non-believers, and then boom, you started popping through resistance levels. I may have changed the levels now like they weren't even there. That's the meat of the rally comes there in the middle part. At that point, the shorts that just held out after this are getting squeezed, longs are piling in, and so that's what you look for here. So again, we start out a little slow, and if we start to break these support levels, we'll probably accelerate to the downside as we go down through there. As an if. Big if, guys. All right, so SPY, same story on SPY. We broke this uptrend line here, back tested it, 289 was, remember, my maximum bounce target. This was where we had our this was the buy signal right here, right? The bullish falling wedge pattern, the breakout, the bullish divergences, and we had a breakaway gap, rallied up, rubber band snapped hard because it was stretched very much to the downside, and then we recently broke support, our trend line, uptrend line support, back tested, overshot my 289 max bounce target by a hair, less than 1%, and now have moved back down below it. So I'm viewing that as a momentum fueled overshoot, but there's plenty of work to be done. There's a lot of levels now because we've traded here with a downtrend recently and an uptrend. So there's a lot of big levels to watch, and that's the same story as I said with QQQ. If the market gets here, how does it act? If it just goes through there with a minimal reaction, you had a big reaction here because this is just the initial, we're still kind of in the near term uptrend. But things may start to change here, and that's what I'll be looking for. How are these levels treated? And again, these would be the support levels on the way down. Any of which could still contain a pullback, but if and as each one breaks, it simply increases the odds that the next one will break and that we're going to go much lower. And then, so that's my preferred scenario. And just as with QQQ, my alternative scenario, which is very near-term bullish but longer-term bearish, is the same thing. We pop up here, make another equal or maybe a marginal new high over that 291.40 resistance, put in a divergent high, and then reverse again. So that would be my alternative scenario, and it still doesn't take us much above where we were the other day, so it's not really going to affect anything much more than that. And we're going to make a run at the previous highs, and then we'll just have to take a look at the charts at the time and see how much more upside from there might be. Okay, we'll wrap it up here and see what tomorrow brings. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.